Anyway, thank you very much, Barris, for having me in FSM1. It's a pleasure to be here. 8 o'clock is very easy for us. We have a lot of valued clients in Asia. I miss visiting them. It's been about 2 years now, and I'm fully vaccinated and anxious to get on planes again as soon as people will have me. But we very much appreciate, the opportunity to get in front of you. 8 o'clock in the morning is pretty easy here for me. And I love talking about the Manulife Investment U.S. Equity Fund, and thank you for recommending it. I'm going to share my screen here with you briefly. So if my eyes dart away from my camera, it's because I'm trying to hit the appropriate buttons and get my presentation loaded up. So bear with me for one moment as I do that. But what I'm going to hopefully do here is spend a little time talking to you about our strategy and investment process. And don't worry, I won't spend too much time there. Everyone will want, I hope, to talk about the macro environment and stocks. It's important to understand our investment process because we're bottom-up stock pickers. We're very much interested in the fundamentals. You've probably heard a lot about passive investment, macro investment, factor investment, quantitative investment. That's absolutely not what we do. In fact, those types of investment vehicles have proliferated to such an extent now that they move stocks around pretty precipitously, and it creates great opportunities for real active managers, stock pickers, people who do the work and invest over lengthy horizons, to capitalize on mispricings. And that's what we've been doing, and that's what's been driving pretty robust performance for us for the last few years. And really, this strategy's been around for 20 years, and we're very proud of a lengthy track record. So I'll get right into this and take you off the very boring opening screen. This is the team of 10 people. Tatiana is listening to this call. She and I handle a lot of the client service and marketing duties. But this is a dedicated team of 10 people. We collectively manage $25 billion US dollars. We have 4 strategies. The one in this vehicle is our largest one. It's about 16 of our $25 billion. It's got our oldest track record. Every one of the 4 strategies we run uses one investment process, and they all have, since inception, alpha. They all outperform by between 170 and 250 basis points per year since inception. It just shows you that this investment process is a very good one, and I'm going to get into that. But this entire team uses one process. We speak the same language. We're all compensated in shares of our own funds, and we all think like portfolio managers and work closely together. We're all based here in the Boston area. We work from our homes. You can see I'm in my office. I never envisioned when I built this home 10 years ago that I was going to spend this much time in this room, but obviously it's been a unique year and a half, and here we are. So what do? We're looking for businesses that can earn their cost of capital over a full cycle. So that means businesses like airlines, commodity companies, upstream energy companies, cruise lines. These businesses have booms and they have busts, and we want businesses that can steadily generate cash flow in good times and bad, and that's kind of where we start. And we want to find good businesses with a competitive advantage, and we want to make sure we pay the right price, and that's where I'm going to go pretty quickly. That's 70 cents on the dollar, as you see here, and I'll explain what that means. And then we have concentrated high active share portfolios, and we're looking to outperform the market. We'll tell you how we do it. So this is our investment process. We incepted this strategy behind the Manulife Investment U.S. Equity Fund in April of 2002. So next spring, this strategy will be 20 years old. And it's not changed terribly much in that time frame. We've augmented it slightly, but it's always a matter of continuous improvement. But we've always had these 7 steps, and the key step is this step 6. So we want businesses with high returns that generate cash flow. We're modeling cash flows. We don't spend a lot of time trying to predict what earnings are going to do on any given quarter. We're trying to think 5 years out, 10 years out. We have a very long investment horizon. And we want businesses that consistently generate cash, and we want to pay the right price, I mentioned. And we get there through this step 6, which is really the most important of these 6 steps. But to put a company through this process takes about 200 hours of work. So it's very labor intensive. And we study everything from the industry to independent business growth drivers, what's disrupting a particular industry or sector of the economy, and how these businesses can earn outsized economic returns. We're, of course, studying management teams and crunching balance sheets, ensuring we're very rigorous in our assessment of risks, trying to understand the ESG opportunities and risks alike. But this step 6 is the key, so I'm going to jump kind of right to an example of this. Now, compliance won't let me tell you what this company is, but it might be named after a rainforest in South America, and it might be the largest internet retailer in the United States. It's also our largest active share, is what we always have for a stock example. So I'm sure you can guess which this is. In fact, I see that compliance forgot to take out Amazon Web Services there, so it makes it very easy. But every one of the 200 companies we cover has a table similar to this. So this is a very simplified version. But you see here 4 scenarios: a best case, base case, bear, and worst. And these 4 scenarios help us frame a range of outcomes. Best case, what will happen when things go exceedingly well and exceed our expectations. A bear case, what will happen in an extreme stress scenario? And we actually experienced those last year, and I'll explain how we were able to outperform and kind of capitalize on some of that uncertainty. But names are trading between our bear and our worst case. And those were outcomes we thought were highly improbable. Stocks were discounting a 5 or 10-year depression when we were pretty confident that we'd have medical solutions to COVID and that there would be a recovery, and a fairly robust one, which we're now experiencing and we'll talk about. But you can see here we're toggling between different growth rates, different margin assumptions across the different scenarios, and we arrive at 3 different distinct discounted cash flow models. So Amazon, we model 15 years. This is a very strong secular grower with one of the best competitive moats we've seen, incredibly competitively advantaged, and they continue to find new areas of growth. So this one we model 15 years out. We also model a lot of consumer staples 15 years because they're very predictable. They grow, at GDP plus a couple percent. Most names, if you're software, your medical devices, you have patent protection, you have intellectual property, we'll model you 10 years. If you're a bank, if you're a home builder, if you're an energy company and you're very cyclical and economically sensitive, we'll model you 5 years. But I stress those investment horizons because it's very important. The market gets very short-term, panicky. They react too much to movements in interest rates, short-term earnings announcements. Stocks will move a lot. But the value of the assets don't change that much. And if you have a long investment horizon, which we hope you all do as individual and professional investors, you can capitalize on these short-term disruptions and generate nice long-term returns. And that's what we're seeking to do. But we have 200 of these tables, one for each company. It's earnings season right now. Facebook just reported, Anheuser-Busch just reported, Google just reported, Amazon's coming up. So we're updating these tables every quarter, and these estimates of intrinsic value should rise. So now how do we buy them and when do we buy them? So every stock for us has some element of growth and some element of value. That's why we're core. So growth. Every business has to be able to compound cash flows. So that's why those companies and they need to do it across cycles. That's why we skip commodities, cruise lines, airlines. They have good times, they have bad times. We want businesses that can steadily compound in value. So this number should be going up every quarter. In fact, last quarter, Amazon's base case estimate of intrinsic value, or our price target, went up well over $300. It's almost $4,500 today. Now, when do we buy stocks? We buy them when they have some level of growth, so they can all compound in value. But we need margin of safety, and we need value as well. And we get that through this discount to intrinsic value. So if you divided back in February of this year, 4,200 by almost $3,400, you get 0.81 or 81 cents. 81 cents is a lot easier for me to say than 19% cheap to our base case estimate of intrinsic value. That's a mouthful. So we shorthand it and say 81 cents, or that's a 19% discount to intrinsic value. We normally buy, on average, when a company is 30% cheap to intrinsic value. And we sell them when the market ascribes a business full value. So if Amazon were to get to, $4,200 in this scenario, we'd probably wait for it to report. If its value didn't go up above that and the stock was trading at 101 cents or 1% above what we thought it was worth, we sell it. So that's the simple discipline. So whether it's a big name like this, we will trade around positions. We buy at 70 cents. We're probably going to be trimming in the 90s. And we'd add if stocks go down. But that's the basic buy-sell discipline. Now I'm going to talk briefly about what's going on in the market, just to kind of update you and share a little performance. And I'll get into some stocks before we get into some macro outlook. But here in the U.S., we managed this last quarter to hit 2 new highs. You can see that achieving these new highs isn't without its risks or its volatility. And we had a couple. And these were both basically inflation related, but this was also Fed posturing and rate related. So it's not the steadiest climb. There's a lot of uncertainty still about pace of recovery, the economic environment. The Delta variant is clearly very topical here. What kind of stimulus is coming in the economy? There's still quite a bit of moving parts impacting the economy. So it's not a steady climb. You're still seeing very divergent sector outcomes. So you can see real estate's up 13%. Staples and utilities, these more defensive sectors, are barely up, and they're materially lagging the index here this past quarter. But this has been a function of the market really for the last year and a half. We're seeing very wide intra-sector valuation dispersion, meaning that some companies that had it good during COVID are very expensive, and those that have not fared as well in this unique recession are very cheap. And that's a good stock picking environment. We've happily been performing, very well. You can see our, Q2 year to date, 1, 3, 5, 10. We've outperformed the market across all these time frames. It's been very robust for the last year. It's, this volatility creates, as I described at the outset, some good stock picking opportunities. What's been interesting for us, growth has outperformed for a very long time. And we own growth and value styles alike. We're a core investor, as I've sort of described. Some element of growth, some element of value. Our performance is very much being driven by both. You can see here Moderna, very much a growth stock. And the title of this presentation, which is Double Dose Vaccinations and Stimulus, which Sally came up with, our local sales representative down in your neck of the woods, we thought was very clever. But Moderna, we can talk about. We've met privately with their CEO in the last month and a half, and we're pretty current there. So I'm happy to talk about the vaccine outlook, but that's very much a growth stock. Cheniere is an energy company that's supplying LNG to, really all over the world to utilities in Europe and Asia. And it's displacing coal in China and India, which is critical, as that's a very dirty form of baseload power that's bad for the environment. And natural gas isn't the best for the environment. No burning fossil fuel is, but this is far cleaner, far more stable source of output. And this is a value-oriented investment. Here on the detractors this quarter, Lennar is a home builder. There's a housing boom here, and we'll talk a little bit about millennials and what they mean to our economy. But millennials are going to drive a boom in consumption here in the U.S. for the next decade. And that's a population dynamic that we have in the U.S. that's unique to us and makes the U.S. a really compelling market, we think, particularly among developed market peers, for the next, as I say, 5 to 10 years, and something we're excited about. But Lennar, if you look at this stock, the ticker is LEN. It's had an absolutely spectacular run. It paused this quarter as people worried that home prices were getting too expensive and might curtail demand. That's a value holding. Workday is a software company and a growth stock. So the point is growth stock, value stock, contributing to performance, detracting, growth stock, value stock. One of the things we bring is the ability to help investors, find alpha, generate capital appreciation across the style spectrum, and we're going to try to diversify risk while we do it. But returns happily have been favorable. How have we been doing it? I won't spend a lot of time on this. If people want to come back, we can discuss it. But what you're looking at here, this is the Russell 1000 Growth Index, and this black one is the Value Index. What's been an interesting feature of this market is just how divergent growth and value style investments have been of late, and how the performance has differed. Oops. You can see here in this February-March timeframe, you had a 10% outperformance, value relative to growth. That's very extreme. And happily, we outperformed nicely this quarter and had about 300 basis points of outperformance. Now, in the wake of the Fed communication, low rates are critical to the whole world right now. The world's awash with capital, as we're going to discuss. But the Fed's communication got people jittery, thinking that they might be tightening or tapering their asset purchases sooner than the market had thought. Rates corrected by over 50 basis points here in the U.S., and suddenly value investments underperformed and growth rallied materially. There was about an 8% performance swing in about a week and a half. So again, very pronounced volatile swings. Happily, in that month of June, we outperformed, and we outperformed, as you saw, for the quarter. What's been interesting, latter half of last year was largely value investments we were buying. This year, it's been very diversified. And what we're showing you here is exactly what we've been buying and selling. And we're always happy to get in front of our clients and discuss what we're doing. And we love talking stocks. So I hope there are some questions there. But Moderna, Amazon, very much growth investments. The financials in January, it had a tremendous run on the back of the vaccine announcements and the conclusion of the U.S. election, which we can also talk about in November. So we just trimmed those on the margin. These had been very successful investments that had appreciated markedly, and they'd gone from about 60 cents on the dollar to about 85. So they're nowhere near fair value, but we were just managing the position size. And we had a real nice opportunity to buy Moderna at about $120, already trading north of 300. So we initiated a position here. This is a company we met with 3 times before they went public in 2018. So this is one we're very close to. This isn't one we just discovered because of COVID. And we've actually owned it since the IPO in another strategy. But these are some growth investments and value investments. EADS is Airbus. That's very much a value investment. And we added to that on some weakness here in June. We exited Microsoft. This is a fantastic business. It's one of the best businesses in the world with one of the widest moats. We're using their software right now. That's how I'm delivering all this. I think this is Zoom, which isn't theirs, but we use Teams, the same thing. And I'm using the Microsoft Office platform, and they dominate business and office productivity market with 80% share. And their Azure cloud business is growing like a very profitable weed. But the whole world knows this, and Microsoft simply is trading at 104, 105 cents right now. So, we love the business. It's going to continue to grow, but there's no longer that margin of safety. So as much as we love this business, we sold it. It's still in our active inventory. If we get a chance to add this back, rest assured we will. But this is a flavor. This looks like we're turning your portfolio over a lot. This may look like a lot of stocks, but our turnover has been less than 20%, really for the last 3 years. Sometimes it'll be 30 or 35% if we're getting a consistently volatile market, but our turnover is low, and that has benefits from a tax standpoint. And this maps to kind of a 4 to 5 year holding period. for us. I'm going to skip this outlook because we've got a lot of macro slides, but I'll talk a little bit about strategy positioning here. And you can see it looks like they left all of our top 10 in here, which we love when compliance lets us leave our slides. High active share. We do not look like the benchmark. This is a high conviction portfolio with a very high concentration in the top 10. If we really have conviction around the quality of a business and we're getting a good price on it, we're willing to have a large active weight and concentrate there. Very good mix of growth and value here. One thing you'll note is it looks like we're very underweight information technology. Now, as you're noticing, we're Zooming. I'm not in your country right now, and I'd very much prefer to be traveling. I personally love it. But technology's delivered us through COVID, as have healthcare solutions. And there's a lot of crowding into some of the best growth names in those sectors. And you can see we're underweight both of them. And that's not because there aren't great businesses. There are. But there's a lot of capital there, and the margin of safety is no longer there, so you just have their growth. And as core managers, we demand both growth and margin of safety. That's what delivers long-term returns in our process. But our technology weight comes from other things. You notice Facebook, which just reported, in Google, they both live in communication services, where we have a pretty significant overweight. Amazon lives in the consumer discretionary bucket. We would argue that's very much, sure they have Whole Foods grocery stores where, my wife shops a little too often. It's pretty expensive, but it's a wonderful store. Don't get me wrong. But most of their business is technology. And if you take that 7% and these Facebook and Alphabet, you'll see we have a healthy technology weighting. And being this underweight tech has not hurt our performance. We'd love to own more of the software names, the semiconductor names, but everyone knows the semiconductor industry is short, and cars need more chips, and your phone needs more chips, and those businesses, which are awesome, they're just very fairly valued, and they're kind of priced for perfection, so we skip those and cover them. This is our long-term track record. As we've shown you, it's very good. There was one bad year in here, 2018. Now, everyone has a bad year periodically. 2018, just to cover that, we don't want to just say we're amazing all the time. But, we had an investment in GE that did not work out well, and that was about 300 of the 800 basis points we underperformed. Now, the rest of it, and all the performance was really in the third quarter and fourth quarter of 2018. You may remember it was trade war panic, and the market decided the Fed was offsides and raising rates, and everyone thought the Fed was offsides and being crazy. And everyone began to think the U.S. was going into a recession, and they began to discount a recession. And we saw stocks trading down to our bear case, and between our bear and our worst case, that to us meant a prolonged severe recession. And we felt really good about the U.S. consumer. We did not think we were going into a recession. So amidst that uncertainty, with a long-term view, we were adding capital to those investments, and that drove a really strong recovery. In 19, you can see we were up 36%, and we've continued to outperform since. But that was one mistake, and then that was the market having it wrong from a macro standpoint. But I just wanted to cover that, as that's an outsized bad year that we're still working through these numbers, but we believe is an anomaly. Here we are 1 year after the COVID recession. This strategy's been around through 3 cycles at this point, with Sandy Sanders, the lead fund manager, there every step of the way. Jonathan's his co-manager. He joined the team in 2004. So Jonathan arrived about here. But you can see we have this track record of performing very well in the back of recessions. This is a very robust stock picking environment. It's a great time to be core, because both growth and value styled investments are doing well off the trough. This is what we did in 2020, and if you want, we can come back to this, but I won't get into too much detail, but this was pretty critical. We all went through COVID, and this was an incredibly disruptive experience for everybody, ourselves included. But you can see what we did is we had to bake the unique nature of COVID into that range of values that I've been describing. And we had to bake in a very unique recession. So it was good for eBay, good for Amazon, good for Walmart. People were shopping from home. It was good for pantry loading businesses because people were going to eat from home, and needed sanitation products. So think Reckitt Benckiser, Clorox, Procter and Gamble. It was very bad for beer businesses, which are normally recession-proof. Bad for Budweiser. Bad for Marriott. Bad for a lot of these service-oriented businesses. But we baked in the unique nature of COVID. We've been meeting with Moderna. We were pretty confident in the health solution they were going to deliver. Like all health episodes in the past that we'd experienced, we expected it to be temporary. We didn't know if we were going to be back to normal in September of 2020 or September of 21, but stocks were discounting 5-year depressions, 10-year depression. Budweiser, for example, we modeled in our worst case the stock going down 25% and then only growing at 1 to 2%. Mind you, it usually grows 3 to 5 for 15 years. The math on that means it takes 10 years for Anheuser-Busch to earn as much money as they had before the pandemic. So that's basically a 10-year depression. We felt very confident that Budweiser, Heineken, Diageo's, these businesses that sell in bars and restaurants and airports would recover quickly. So that's just one example, but whether it was Marriott, whether it was, a lot of these services businesses were really discounting severe and prolonged negative outcomes. And that we had the confidence with that math having been done and that range of values we've been using to buy these businesses at their worst case scenario. So we did. We were selling the stay-at-home winners. Like we were trimming Amazon, which we still own in large size, Pepsi, Walmart. Gilead got $30 billion of value overnight for remdesivir, which we're not even really using anymore for COVID. So the market got prematurely excited about a drug no one had heard of that we'd known about, of course, but we sold that. And we channeled them into investments that were under extreme stress. And that continued into early April. All this activity in April was really this first week of the month. And you can see the outperformance was pretty precipitous. Now we've continued to experience bouts of volatility. These were both kind of second wave related. They were also electoral politics related as the market began to digest a potential blue wave and Democrats sweeping into office and being much less business friendly. But that created mispricings, and you can see every time we got one of these drawdowns, it triggered some activity. When the market gets panicked, it misprices securities, and passive investors will sell very good businesses, and it's our job to be there to buy them. But we're buying almost exclusively value in the latter half of the year, and it drove some nice outperformance that has continued into this year. So with that, I'm going to transition. We've done about 25 minutes of kind of how we do things, and hopefully talked a little about individual stocks that's going to stimulate some questions. But we're now going to get into a little macro, and I'll update you on how we're looking at things. So it's important to remember as I go through this, we're bottoms up fundamental stock pickers that do hundreds of hours of work on a business and then continually analyze it and update that range of values. And that bottom up process drives our decision making. That said, we've also got to be macro aware. So we've been in a period of pretty excessive macro uncertainty for some time. Really since the global financial crisis, we've been at elevated levels here. The green line is the U.S. You can see Trump was very bad for global policy certainty. Trade war created consternation. Supply chains needed to move around. When that happens, it's harder to invest your capital as a business because you're less certain about the return outcome. Clearly, the pandemic has taken us to absolute new levels. We haven't seen something like this, really in decades, and certainly not with all the modern media we have covering it. So this is, not to mention the mobility we have globally to travel and unfortunately pass on this pandemic. But this is definitely abating. Also of good news, we can talk about it, is Biden's policies really have been pretty benign to this point. We can talk about some of the the regulatory risks inherent in the big tech names, as that's a topic of interest for a lot and something we're spending time on, of course. But in general, this policy uncertainty decline, Biden having ushered in a better kind of trade relations environment and a little more stable Twitter sphere, at least, and seemingly political agenda with an infrastructure bill that looks like the first bipartisan piece of legislation we've had in about a decade here, that kind of augurs well. So that's kind of a global phenomenon. And, we can see the world is awash here with capital. And it's not just us. This is a percent of GDP. So ours is still relatively low. But there is a lot of capital floating around. And the whole world is addicted to low rates. But some of that stimulus has been abating as this policy uncertainty recedes and we get, the pandemic slowly but surely under control. So zooming into the U.S., but still talking globally a little bit, I want to talk about the U.S. consumer. When you think about the U.S. economy, the consumer is first and foremost got to be your focus. It drives 70% of GDP. Housing is probably another, and construction is probably another 15%. But we're a very consumption-oriented economy, as you're probably aware, and we have a huge wave of consumers coming. So this kind of covers the millennial demographic, which you may be hearing a lot about. And I'm the father to some millennials and some Gen Zs myself. I have 4 kids. But this is us versus Europe, China, and Japan, the other big global economic powerhouses in most developed economies. And this is the millennial demographic, and this is a rolling representation of adults aged 30 to 49. Now, 30 to 49 is important because that's when you form a household, you incur debt, you buy a home, you bathe, feed, and clothe your children, you go on the biggest vacations, and that's when your consumption peaks as a consumer. And you can see here that the millennials really through 2025 are just beginning to peak as a cohort. And that's going to be incredibly stimulative to the economy. Really since, the boomer generation, or our Generation X, that I'm a part of, really peaked in the kind of 2004 time frame. And so it's been a while since we've had this kind of demographic stimulus, but it's incredibly positive for the economy. Now, Europe, socialism hasn't been good for population growth, and they actually have a shrinking population, which can be a problem for some of their entitlements and some of the the spending programs they have in place. China, as you're probably well aware, is reversing its one-child policy. That's having a negative impact on their GDP because their population growth in that 30 to 50 age bracket is declining. And same thing in Japan. It's been a large problem in Japan. That they don't have this population growth. So again, this is an advantage the U.S. has over other developed markets, and we think makes it an attractive place to put your capital. Now, this is a little dated. It's from right before the pandemic, but it's important to look and remember that snapshot in time. The U.S. consumer is incredibly under-leveraged. It was something that Jamie Dimon was and still talks about. He's the CEO of J.P. Morgan. Brian Moynihan, the CEO of Bank of America, talks about this. We were at multi-decade lows in indebtedness. And this is percent debt as a percent of disposable income. So you can see this data goes back to 1980, but it goes all the way back to the 60s. Very low debt. This is a function of the post-financial crisis hangover, if you will, where people are cautious about their balance sheet and about taking on too much debt, be it mortgage, student loan debt, auto debt. So we came into this recession from a very healthy debt standpoint. The consumer was fully employed and confident. Now we had a pandemic, and the whole world has suffered here. But the stimulus and this is dose one in today's title. But the fiscal stimulus has been overwhelming globally, and you can see here the U.S. is the biggest piece here. We have given our consumers about as much money as they can. In fact, it's been a problem. Some people have been making more money with their stimulus checks than they were in their jobs. So they've chosen not to take on the risk of going back to work and have been collecting unemployment insurance. That's all about to expire. But there's an absolute war chest, and it's not just the U.S., it's the entire world. This is a collection of both that stimulus and foregone consumption. I haven't been out to a lot of restaurants. I haven't taken a real vacation that requires me to fly anyplace. I've been on a plane in a year and a half. So that foregone consumption is in this number, but that's all sets up very well for a recovery in consumption. And here in the U.S., the demand for workers and labor is intense right now. So unemployment's been coming down. We expect that trajectory to continue. Now, housing's in the midst of a boom here, as you may have seen, and we're investing in this through Lennar, which is a top 5 holding for us and a name we know well. But millennials are forming households. The pandemic has really stimulated demand to buy homes because you need to work in them. It's that much more important. And our go back to work plan is 3 days in the office and 2 days at home. So there's both the millennial demographic forming households and just needing a place to live and shelter after a decade of underbuilding homes. You can see we've underbuilt homes. The long-term average needed to house our economy at its current population growth rate is 1.5 million homes right in here. You can see we underbuilt homes for a decade, and it's catch-up time. So we feel pretty good about housing. That, too, will be very stimulative for the U.S. economy. Small businesses clearly were shocked here, but confidence is rising, and you can see it's back to very kind of elevated levels. This rose, nicely under Trump. Trump, love him or hate him, he was generally speaking good for business. Most people are glad he and his tweets are gone, myself included. But he was very good for business. And he lowered tax rates, and small, medium business confidence started to drive an economic acceleration. You can see here that confidence is recovering pretty nicely. And that's important because these small businesses referenced here generate about 80 to 90% of the jobs in the U.S. So they're incredibly important. Here are capital spending plans. This data goes back to basically 2000. You can see on the back of this disruption, which was very short, capital spending plans are accelerating. And that's doing it because the U.S. is recovering, the whole world's recovering, but we're coming off 4 years of trade war uncertainty. So there's a lot of pent-up demand to invest capital globally, and there's a very significant global recovery we have ahead. The U.S. recovery is leading it. Vaccinations here, we've been ahead of the curve, and the consumer coming into it was very healthy. So the U.S. with our double dose of vaccinations is doing well and is leading globally, but China's been doing well for its part, and rest of world is coming out of this as well. Now, I'd be remiss if I didn't at least talk a little bit about inflation. It's a big source of concern right now. Inflation is elevated off very low rates, but we don't think it's going to be a problem. We think it might be a little more persistent. This cycle, because supply chain disruption has been so significant, and there's been so much stimulus pumped into the economy. But if it's one thing we know, it's kind of a lot of the commodities and raw materials you need for your economy to function effectively. Those markets normalize. You don't need to look any farther in the U.S. than lumber, a very important input if you're a home builder. Lumber prices skyrocketed, and they're now off 60% off that high. The problem is not that we don't have enough timber, it's that we don't have enough timber mills, and the timber mills weren't working at full capacity through COVID, but they're pretty quickly getting those mills working again, and the wood's coming, and prices are 60% off the peak. So this is going to be the case for a lot of markets, and we think inflation will be transitory. What's going to be more important is how the Fed communicates their response to inflation, to the recovering economy, to unemployment, and that's what's more likely to create volatility. But it's all related, and inflation's going to be here for a while, really probably for the rest of the year. But we don't think we're looking at outsized inflation, and that's an unmanageable risk. With that kind of brings me to appendix. I have a lot of additional slides around how we perform in different rate markets and rising rate markets. You can see we perform well. This is our full history, everyone. I mentioned we're almost 20 years old. These blue markets this is the Russell 1000 growth minus value. So this is a very value-led market. People forget that value investments have outperformed about 70% of the time. If you look at like the last 100 years, value has really driven the bus because it's really been growth driving it, for well over a decade at this point. But we outperformed when value was leading. Growth has been leading the market, and we, growth kind of peaked right here, but we've outperformed through a growth-led environment, and that's the advantage of being core. You can get through one manager exposure to both value, style alpha and growth style alpha, and we'll balance those investments for you. And we show you what that looks like here. And you can see that we've always had about a third value, a third core, and a little over a third growth. And this is what our portfolio looks today. So these dots, if they're bigger, if they're a larger percent of our portfolio, this is the Morningstar chart from May. You can see plenty of growth investments, plenty of value investments. This dot, and our ellipsis, was very much in the center of this pictorial representation. We were very core. But with growth underperforming in the first quarter, as I showed you, we were adding to growth a little bit. And growth's outperformed. So we'll take advantage of these market moves slowly with a bottoms-up process and try to capitalize on opportunities when they present themselves. But we've always been very consistent in our balanced approach here. You never know when you're going to get a prolonged period of value outperformance. We think value is going to do very well for the next couple of years as we come off the earnings trough. Those earnings are the most depressed, and they're going to add the most to aggregate earnings growth for the S&P 500, our primary benchmark. But growth-style investments, we don't think they're dead. They're going to continue to perform well, and there's good secular opportunities there. And we think, some of the ones with the biggest competitive advantages that can continue to generate healthy economics. So with that, I'm going to pause. I'm going to try not to give everyone vertigo as I go back through all these slides. I'm happy to touch on any of them, but I'm going to just go back to our portfolio page and see what kind of questions. But with that, Ferris, I'm going to pause and see what's on your and everyone else's mind.
Okay, thank you so much, Michael, for the presentation. Yeah, we really appreciate the explanations that you have given to us. Yeah. Okay, so perhaps we'll move to the first question. No, the U.S. market has been on a rise. On a rise. It has been on a steady uptrend. Okay, for the past few months, and also for the rest of this year, basically. So what are your thoughts? Do you see a cooling off in the market anytime soon, especially for the rest of this year? What are your thoughts?
So the crystal ball, I wish I had one behind me because I get that question a lot. I've got all kinds of stuff in my office here, lots of props, but I don't have a crystal ball. But here's what I can tell you. We are definitively early cycle. The last cycle was the longest we've ever had. It lasted 11 years. There's a lot of pent-up demand for global growth on the back of that uncertainty I discussed, and we're just coming out of the bottom. We're just getting, employment headed in the right direction. There's a lot of stimulus coming. There's infrastructure bills coming. So there's a long way to go. So I can't tell you over the next 6 months, what the market's going to do. I think it's going to continue to go higher, and we think we're early cycle pretty definitively. So we want to be invested in this market. You're going to get bumps along the way. I don't think the drawdowns will be any more than I don't think you're going to get a lot of 10% corrections. The reason for that is there is considerable cash on the sideline. There has never been more money in money market funds in the U.S. And if compliance lets me, or you tell me it's fine, Ferris, I'll start pulling up other charts from my letter, and we do write a quarterly letter, that show just, and I did have that monetary, stimulus slide. There's so much money out there. It's in money markets. Corporate buybacks in the U.S. just announced in the first half of the year it'll be the largest corporate share repurchase in history. And this is just the first half. There's still 6 more months of these guys to announce intentions to buy back stock like they're doing now during earnings. So corporates are going to be buying. We're early cycle. There's a lot of cash on the sidelines. When we do get these drawdowns, like you just had one a week or so ago, as people worried about, and during the, that Fed unease that I showed, these need to be bought and invested in because we're early cycle, and the trajectory of the market. I showed you that chart. Oops, I'm missing a virtual research forum. Sorry, that popped up on everyone's screen. This is more important for me than my virtual research forum. But I showed you this slide here. This is year 1. It's a pretty robust year, but usually these cycles, at least the last 2, you've had pretty healthy returns over 5-year periods. So you're 1.5 years in to a short cycle. I would argue you probably are going to have a longer cycle. I think the pace of recovery, it's going to be slow, certainly slower than everyone wants, because the rest of the world isn't getting vaccinated as quickly. We're going to be dealing with COVID at least through all of next year. The good news is we're becoming accustomed to it. Businesses are clever. They're adapting. That's what private capital does. And vaccinations are getting out there. Moderna will have, 3 billion doses for folks next year. That's more than enough for us here in the U.S. We'll be getting boosters. We'll get on top of this, but it's going to take a while. And that slow pace probably means longer cycle. All the more reason to get in now when it's early, in my opinion.
All right. Yeah. So Adeline, I hope that this answers your questions. Yeah. And then the next question will be, perhaps you could take us back again to the slide where you explained to us what did this particular fund did during the drop back in 2020. Perhaps you could summarize to us and perhaps let us know maybe what are the 3 key things that the fund manager has done correctly at this point of time. Yeah. So as to let's say if any black swan event were to happen, our investors here would know, oh, okay, these guys, they know what they're doing. Yeah. So perhaps you would like to summarize and give us 3 key takeaways.
First, and foremost, what we did is we stuck with that investment process discipline, that range of values. And, we actually met with Jeff Bezos face-to-face on February 26th, okay? We've been an investor in Amazon since 2003. We may not meet Jeff anymore because he's busy with Blue Origin flying into space with his brother, and he's no longer the CEO. He's still the chairman. We still hope we get to meet him every 2 years, but we get to meet with him because we're long-term investors, which he appreciates, and that's going to be one of my points. But we're also big enough, if we'd been there since 2003 and we managed $1,000, it wouldn't matter. But we were talking about how much cargo was on boats, and whether what was going on in Asia and China was going to impact the supply chains and how they were adapting. We weren't talking about shutting down the global economy. That was February 26th. So we didn't know this was going to hit, but what did we do? We went into our offices, through March 6th, and then we went home and worked virtually. But we baked in the unique nature of COVID into that range of values. So we spent 2 weeks where we didn't panic. We didn't go all in the utilities and all in the staples. So we probably could have protected capital better. You can see we underperformed here, but we didn't panic. And we had a long-term investment horizon, and we capitalized on the opportunities presented to us. So it's don't panic, maintain a lengthy investment horizon. With all this passive money and factor and quant money, they're looking at historical data, and they're looking at consensus data 1 to 2 years out, and we're thinking a minimum of 5 years. So you have to have a long-term view when it comes to your investment horizon, particularly with respect to equities, because drawdowns are inevitable. What's been an interesting function of the market is just how fast it goes down now. And you can't plan for that black swan. You can't predict what's going to come. We certainly couldn't predict this. What you can do is stay disciplined, maintain your long-term focus, and capitalize on that disruption with a good investment process. And that's what we did, and that's what drove this next leg of the recovery. When everyone else was panicking, throwing out stocks because, oh my gosh, you know, my quant program says it has too much debt. Sell anything with debt. Sell anything with consumer exposure. Sell anything illiquid. They were throwing out small caps just because they were hard to sell, and I might not be able to get out tomorrow, so get out today. So we were disciplined. We were long-term, and we had a very in-depth process with a lot of work, very in-depth analysis, a very solid knowledge of these businesses and the management teams that run them, and we invested. And that's what we're going to deliver anytime there's uncertainty. And that's something we're proud of. And as I said, we have very good performance, you know, for the full year, but, you know, that was a bumpy ride. And you have to be prepared for bumpy rides in equities, and we're not going to outperform every quarter. And when macro money's swashing around again, we're going to underperform. Anytime you see that, you should jump into this fund. And I would encourage anyone on macro uncertainty to be adding capital to this market because, as I said, we think we're early cycle. But hopefully that gives you some perspective, and I'm, of course, happy to walk through any of the stocks we were buying in here or selling for that matter.
Yeah. Thank you so much for your answer. I believe, some of our viewers would definitely like to hear that, you know, not to panic when the market is down. Stick to their investment horizons and also to their strategies. So for those who have any questions on the US market, kindly throw it out right now. You know, we are happy to take as many questions as possible for Michael over here today. Okay. The next question will be, what are the stocks, or rather what are the markets that the investment team is looking at right now that you believe that will deliver an alpha in the long term?
Well, U.S. markets.
Yes.
Now, one thing I can say about our strategies, sorry that was stuck there, is you know, the U.S. market incredibly healthy. We do think emerging markets are going to perform well. There's a lot of recovery there. The path and the uncertainty makes them riskier. Excuse me. But there's, in all probability, emerging markets could, you know, outperform the U.S. market for the next 12 or 18 months. Now, our portfolio is predominantly based in the U.S. Less than 10% is you know, European domiciled businesses. But most of them, like every single one on this page, is based in the U.S. But we have about 35 or 40% of our revenue exposure is outside of the U.S. So we just built a position in Walmart. They own Flipkart in India, you know, so it will participate in India's growth and transformation to a digital economy. Guess who else is there? Facebook. You know, they have WhatsApp as well, which is an important, you know, mechanism for payments and monetization there. Amazon's there. So we don't have a ton of China exposure through these businesses. A lot of them don't operate there, but we have good rest of world exposure, and so that global recovery will also benefit this portfolio. But it'll do it through these safe U.S. dollar denominated securities and are, you know, highly regulated, very predictable, you know, markets. So that I'd say in terms of getting to a sector level in the U.S. Every sector has its haves and have-nots. Clearly, financials we think are attractive. If you're looking at PE or traditional multiples, they're still really cheap relative to the market. they're also cheap in our range of values framework based on cash flows and the discounted cash flow models we use. So we love financials here, and we've trimmed them on the margin, but they remain really kind of compelling. Inside of Staples, I mentioned, there are definitive haves and have-nots. A lot of good food service companies, that deliver food and products to restaurants, to stadiums, to universities, to cafeterias in your office building, which I haven't been to in a year and a half. Those are businesses in the Staples universe that are very attractively priced right now. So every sector has its winners and losers, and more attractive and less attractive businesses. Healthcare, we're having a little trouble finding a lot of value just because it's got us through COVID and it's pretty crowded. Same thing in information technology. Communication services and some of the regulatory overhang around Facebook, Google, Apple, Amazon, that breakup potential actually has these top names in our portfolio looking really attractive. And then these two names right here, if we didn't have these big positions, we'd start them today. They are about as compelling as you get. Housing has a long runway, and Lennar is, trading like the cycle has to decelerate from here. It's not trading like it was in March of last year, like we were going to go in a prolonged housing depression. But at that and Cheniere, which is an energy company, energy's been tough sledding in the U.S. People have been like, why do you have an energy overweight? Energy is awful in the U.S. Well, we don't own the upstream energy companies that got killed when Saudi Arabia and Russia kind of declared war on the U.S. oil patch. You may remember that. It was like in the recession. It's like, nope, we're going to keep pumping oil at you. We want to push the U.S. guys out of the market. You can see our entire energy position is that one stock. And it's a really compelling investment that, as I mentioned, is better for the environment than coal. I keep bringing up the environment. ESG is very important here in the U.S., and we have ESG fully integrated into our investment process. This is our most carbon intensive investment. So our strategy has about half the carbon intensity of the market. So if the S&P's carbon intensity is 100, ours is 50. So in general, this is a very environmentally friendly portfolio. Now, this is our least half of our carbon intensity comes from this one investment. And what we tell you is, first of all, they do a very good job when they build their LNG trains, cleaning up and caring for the environment around their plants. Now, they do make LNG, and LNG is a fossil fuel, and customers burn it downstream, but it's displacing coal, as I mentioned. So if you're looking at scope 3 emissions, this is a great thing for the planet. But it's our dirtiest, most carbon-intensive investment, but it's something we're excited about. The U.S. has converted from coal to natural gas, and natural gas combined cycle turbines here to generate a lot of our baseload power. And China and India are coming, as is the rest of the world. Coal's got to go away, and these guys are helping make that happen.
All right. Thank you so much for your answer. Maybe we'll take one last question, and then maybe you could sum it up with your final words. Okay. So I'm not sure if the team of fund managers view this stock, but one of our viewers asked about Regeneron Pharmaceuticals. Do you have a view, or do you have any comments about this particular stock?
So Regeneron is one that's not in our active inventory right now, and it's not in our portfolio. So I can't speak with any degree of expertise around Regeneron, but they've I think it was eye-related products that differentiated them, and it was macular degeneration. But we talked about it as a team and debated whether to put it under active coverage, and it's not in our active inventory today. Not to say it's not a good business and they don't have a competitive advantage, but we can't cover every company in the world, and that one's not in our active inventory. So unfortunately, I have to punt on that one.
Okay.
I was sure people would ask me about Moderna. Their growth has been absolutely spectacular. So I expected that one. I didn't expect Regeneron, and unfortunately, I don't cover it, so I have to punt.
Okay, I think you have covered quite extensively about Moderna. Yeah, so yeah, viewers who have missed Mr. Michael's coverage on Moderna, maybe you can rewatch the replay again on YouTube after this session. Okay, so Michael, any last words before we leave you for today? And
well, Ferris, no, thank you very much. For having us. Thanks for the support of Manulife Investments, and for to Sally, who works there, for giving us this opportunity, and thank you for your recommendation of our U.S. equity fund.
No problem. Yeah.
But we feel very good, as I've said, about the U.S. markets. We're confident. All of our own capital is invested in these strategies, so know that we're true owner operators. And we believe in this process. We believe it works, and we believe we're early cycle. So I'd encourage you all to invest, and implore everyone to maintain a long-term investment horizon, and to try to tune out the noise in the markets and the ups and the downs. It's natural human nature to feel that anxiety, but the long-term history of this market is that it goes up about 10% a year. And there are a lot of exciting things going on globally. We've got a big global recovery. The U.S. is leading and on its way. Vaccinations are coming, so life will normalize. Moderna and Pfizer and mRNA technology will help us all get there. And we're looking forward to getting out to your market and seeing you in person before long. So please have me out there in person. I don't mind flying the other side of the planet. In fact, I really enjoy it. And I hope to see you all
we'll be very
live
pleased to have
before
you.
too long.
Yeah. Okay, there you guys have it. Okay, thank you very much, Mr. Michael. Okay, for those of you who want to have a look at this fund, head over to www.fsm1.com.my. Okay, you can have a look at this fund called Manulife US Equity Fund. Okay, and also we have a Manulife healthcare fund as well in our recommended funds list. 0.5% sales charge ends by tomorrow. So if you haven't gotten a chance to grab any of those recommended funds, please do so by tonight or by tomorrow. Okay, so thank you very much once again, Mike. Yeah, have a good day, and thank you all of you for tuning in. Till then, goodbye.
Thanks. Bye.
Thanks, Mike. Thanks, Sally. Bye.